What is Katsenelson's absolute PE? Well, in order to define this valuation multiple, we must first define financial risk, business risk, earnings visibility, and Katsenelson's basic PE. This is my blog, Relative Value Investing. You can access it using the link listed above in the URL, relativevalueinvesting.blogspot.com/p/financial risk, or just relativevalueinvesting.blogspot.com if you wish to access any of my other reference materials or blog posts. Applicable variables for financial risks definition that require emphasis are capitalization, capital structure, market efficiency, cash flow to debt ratio, amortization, and interest payments. A great scale for deducing a company's financial strength is that of the Piotrowski F-score, named after the famous University of Chicago professor James Piotrowski, known for devising the fundamental scale. The scale assigns 1 point for each criterion the company coincides with, such as profitability, leverage, liquidity, source of funds, and operating efficiency. A score between 0 and 3 is weak, while a score of 7 to 9 is optimal. Note that analysis is often ambiguous. Nevertheless, companies of lower market capitalization tend to confer greater financial risk, or higher risk in general. Another keynote, this can alternatively be derived from a company's earnings per share growth and sustainability. What is business risk? Applicable variables that require emphasis in this definition: industry/sector, product innovation, competition, business cycle, consumer loyalty, branding, environmental risks, and operational efficiency. An objective metric of business risk is the Altman Z-score, contrived by Professor Edward Altman of NYU's Stern School of Business in 1965. The model proposes the following formulas postulated within his book, Corporate Distress and Bankruptcy. Published in 1968, the Altman Z-score formula is 1.2 times A plus 1.4 times B plus 3.3 times C plus 0.6 times D plus 0.999 times E, where A is working capital divided by total assets, B is retained earnings divided by total assets, C is earnings before interest and tax payment divided by total assets, D is the market capitalization divided by total assets, and E is total sales to total assets. A Z-score in excess of 2.99 implies it is unlikely to declare bankruptcy. A score between 1.23 and 2.99 denotes a sort of gray area status, while a score below this range indicates a distressed financial state or sector deflation. The Altman Z-score is not attributable to banks, insurance companies, private lenders, or any such financial institutions. What is earnings visibility? Corporate analysts or executives' performance estimate or forecast. A reluctance to divulge or evident omission often signifies obfuscation of low performance, i.e., weak future earnings. Conversely, an eagerness or forthcomingness frequently suggests high performance, i.e. a strong earnings report. Exceptions and anomalies exist, such as Enron, whose executives perpetuated an unremitting optimism until the company subsequently declared bankruptcy, whereafter the vast majority of whom were incarcerated for fraud. So its executives were incarcerated after concealing liabilities within an SPV, a special purpose vehicle owned by one of the company's subsidiaries. To clarify, a Beneish M-score is a statistical model that utilizes innumerable financial ratios, all in conjunction to detect the semblance and significance of earnings manipulation. The model was formulated by Associate Professor Masad D. Beneish of Indiana's Kelley School of Management and first demonstrated in his book, The Detection of Earnings Manipulation, published in 1999. The model proposes the following formula. His M-score is equal to negative 4.84 plus 0.92 times DSRI plus 0.528 times GMI plus 0.404 times 0.327 times LVGI, where DSRI where DSRI is equal to net receivables divided by sales divided by net receivables, where in a series or where the number in the series is subtracted by 1 times the number of sales, where the number in the time series on the balance sheet is so subtracted by 1. GMI equals the sales, again the current time, the period in the series, minus 1 minus COGS, the T minus 1 divided by sales, T minus 1 divided by the securities to the current time divided by total assets, the current time, divided by 1 minus current assets. Anyway, a simpler version of this is provided in my original video, where I expounded upon various quantitative metrics and ratios. During our initial meeting, I discussed this, and a recording was uploaded to the YouTube channel. Of course, the resolution might not be great. Well, this is a simplified version of the Beneish M-score, a much easier to comprehend earnings manipulation detection formula. Here it has as listed STA equals CCA minus CL minus DEP divided by total assets, where CA is the change in current assets minus the change in cash and cash equivalents. CL is the change in current liabilities minus change in current long-term debt minus the change in income taxes. And DEP is depreciation and amortization. I should have listed that here rather than the full-blown Beneish M-score, as it is quite difficult to fathom. A Beneish M-score greater than or equal to negative 2.22 extricates the company, while a score of less than negative 2.22 indicates some extent of earnings manipulation predicated on the total deviation from this crucial point. So a company with a score of negative 1 is committing a greater extent of earnings manipulation than a company with a score of negative 1.5. And the opposite would be true as well. If we were using positive values. Oh. Okay. So Katsenelson's basic PE can be defined as follows, assuming a no growth PE of 8. Company quality is determined by the three preceding concept slide variables: business risk, financial risk, and earnings visibility. Katsenelson recommends ranking each category by designating a score based on a holistic qualitative analysis of the underlying assets. The sum of the three scores ascertains company quality. The basic PE point designation model entails the assignment of one additional PE point to fair companies, less than one additional point as a basis of personal subjective premium, e.g. 10%. A 10% premium would equal 0.9 to great companies. A greater than 1 point premium to poor companies predicated on one's ambiguous discount. For example, 20% would be 1.2. Additionally, Katsenelson limits this basic PE to a maximum premium of 30% and assumes average interest rates. The initial base PE concurrent with zero growth contracts and expands according to interest rate resurgence and decline, respectively. Thus, we may conclude that there are significant risks latent in implementing current interest rates rather than a projection of future interest rates. Though I'm fairly confident interest rates will remain zero for the foreseeable future, or 0.69%, whatever. The formula is as follows: the fair value PE equals the basic PE times 1 plus 1 minus business risk times 1 plus 1 minus financial risk times 1 plus 1 minus earnings visibility. Now to define Katsenelson's absolute PE, Katsenelson assigns, sorry. Anyway, to further clarify, Vitaly Katsenelson is an adjunct professor at the University of Colorado's Business School. He is the author of Active Value Investing: How to Make Money in Range-Bound Markets, and I believe the Little Book of Sideways Markets, which is part of the Yahoofinance Little Book series, like the Little Book That Beats the Market by Joel Greenblatt. That's another book in the series. He immigrated to the United States from Russia in the 1980s and obtained a degree in finance and accounting from the University of Colorado, whereupon he started an investment trust focused on value-oriented investing. He contrived this model to factor in, as he states in his book, Q, V, G, the which represents quality, value, and growth, the big three factors in determining a company's value. So this is really a holistic valuation method, and I often prefer it when looking at companies of a certain echelon, of a certain breed, especially in materials and industrial sectors, as well as energy when the sector isn't totally deflated. Though it's not great to apply this method to companies with extremely high exposure to commodities. Katsenelson assigns 0.65 PE points per percent of EPS growth, with the exception of decimals, which are always rounded down. For example, 1.47 would become 1. In EPS growth rate in excess of 16% receives 0.5 PE points for each percent exceeding this mark. Conversely, dividends are tangible and accessible capital, hence a higher point attribution due to greater liquidity. 1 PE point is designated for every percent of dividend yield, manifesting a clear linear relationship as postulated within the following chart, published in Katsenelson's book, Active Value Investing, Making Money in Range-Bound Markets. Note that we should remember decimals are always rounded down. Again, for example, 2.43 becomes 2, 2.67 becomes 2.5.